Hi folks, in this lecture we're going to discuss about debit spreads. This is a strategy that I use a lot, especially for my directional trades. So let's see when we have to use the debit spread. It's to be used mostly when you have a definitive directional view, whether it is bullish or bearish, right? And ideal scenario is that momentum should be there already, or you expect certain momentum to be there. Maybe you are at a breakout point, and that is where you expect the momentum to be there, so you can create a debit spread, right? uh, as you're starting off, try to deploy this on the monthly expiries. Once you've done a number of trades there and you understand how this is working out, then you can probably try your hands in the weekly expiry as well. Capital required is much less compared to option selling. The simple reason being, in a debit spread, we buy a strike and we sell a strike. So basically, we get a margin benefit. And generally, the debit is not very high. The spread between the two strikes is not very high. So you get decent margin benefit. So in case of Bank Nifty, if I think about it, you can make a debit spread at with a margin of as low as 25,000, right? All right, so let's first understand how do we create a debit spread. So let's say this is the current market situation. The market is at 43,345, and our view of the market is bearish, right? So we'll not get into how we've created that view. That's a separate topic. Let's say our view for the market is bearish. So how do we create a debit spread in this case? So what we can do is we can choose a buying strike. So in this case, let's say leg one is the buying strike, which is 43,000 put, which we will buy by paying a premium of 82.7. All right. So this will be our leg one, which is the buy leg. And then we'll also have a sell leg. So we'll sell 42,800 put, right? And we sell this. So we get a premium of 49.3. So net, if you look at it, the the spread, first of all, is of 200 points. So difference between the strikes is what we call as the spread. The net debit is going to be 33.4. So the buy premium minus the sell premium, right? So this is what we'll have to pay out of our pocket to get into this spread. All right. And max profit will be spread minus net debit. So our spread is 200, net debit is 33.4. So max profit position will be 166.4. When will this happen? This will happen if we close below 42,800 at the time of the contract expiry, right? So whatever these contracts are, 43,000, 42,800. Let's say if these are weekly, then on the weekly expiry, if we settle down below 42,800, so that is where our maximum profit will be at. Max loss is equal to the max debit. So whatever we have paid to buy this spread, basically, that will be our maximum loss. When will maximum loss happen? Maximum loss will happen if we close below 43,000. So if both of these go to zero, that is when the max loss would be. Right, and break even formula is leg one minus net debit. So that comes out to be 43,000 minus 33.4, which is 966. So this is where we'll be in a no loss, no profit zone. Below this level, 42,966, we'll be in profit. Above this, we'll be in loss. And at 43,000, we'll have a maximum loss. All right. So reward to risk, what is the reward to risk for this trade? So the max that we can make is 166.3 and the max that we can lose is 33.4. So the reward to risk here is 4:1. So generally these are directional trades, right? So here we would want the reward to risk to be in our to be in our favor, right? Because generally from my experience, what I've seen in directional trades, 40% is a very good accuracy. If you're able to do 40% success rate in a directional strategy, that is fantastic. And although the success rate is slightly, you would say, on the lower side compared to option selling, but this reward to risk compensates for low success rate. So that is how this works. I mean, you have a 35 to 40% success rate, and then you have a 3:1, 4:1 kind of a reward to risk. So over a period of time, you end up making good money if your direction is right, even 30-40% of the times, right? All right, so next let's try to draw the payoff chart for this particular strategy, these particular strikes, right? So on the x-axis, we have the spot price, and on the y-axis, we have the profit and loss. So this is where we are presently, right? And this is our sell strike, this is our buy strike. So 43,000, 42,800, this is the spread. So so max profit will happen when we are below 42,800. So I think there is a mix up here. The 42,800 should be here and 43,000 should be here. So that's, I'm sorry for that mistake, but so you can assume this is basically 42,800. This is 43,000. So max profit will happen once we go down below 42,800, right? And that will be, let's say lot size is 25, so that will be 4165. And max loss will happen once we, if we are above 43,000, so that will be a max loss of 835. So this is where the max loss will be. Again, let me reiterate, this is 43,000 and this one is 42,800. The one in the green is 42,800, one in the red is 43,000. All right. So this is what the payoff chart would look like at the time of expiry. All right. So yeah, so there are certain adjustments that we can also do, right, in case of debit spread. So what I generally like to do is if the debit is not going in my favor, I like to convert it into a ratio spread. So we'll learn more about the ratio spreads in hopefully the next session. But for now, I hope you got a good idea of what a basic debit spread is. Yeah, so the break even is here, 42,966, somewhere between the two strikes. So, all right, guys, thank you for patiently understanding this debit spread concept. And if you have anything any doubts, any queries, feel free to put it in the general batch, right, or ask it in one of our live sessions. All right, thank you. Bye.